The next ratio we're going to look at is ratio number 12, which is one of our profitability ratios. We're going to skip over ratio number 11, okay, the profit margin on revenue. So the return on revenue is actually, if you think back to your vertical analysis and everything that was compared to revenue, and that's one of the ratios here. So return on revenue is taking the profit for the year, which is the 80,000, divided by your revenue, which is 2.5 million, to give you a return on your revenue of 3.2%. Okay. So our next ratio, which is also a profitability ratio, is your return on total assets. So again, it's looking at the profit for the year divided by your total assets. So your 80,000 divided by what your 1.2 million. And this measures the return on the funds that are invested by both the owners and the lenders, okay? So by using the figure of total assets, it encompasses everything that has been invested. It takes into all of your debt, your liability, as well as your equity, because as you know, the total assets is equal to your total liabilities plus your owner's equity. So both of those are 1.2 million. So by taking the profit for the year and dividing it by your total assets, it's showing the return on all of the funds that have been invested, both those that have been borrowed and those of the shareholders that are still being held by the company in equity. Okay, so now we'll look at the return on equity alone. So instead of looking at return on total assets, we look at the return on equity. So again, your profit for the year, which is your 80,000, divided by the equity or the amount of profit that's being held within the organization as equity. As you know, equity is made up of the amount that was collected by selling shares and the earnings that were retained in the organization. So of the profits that belong to the owners, which are the shareholders, it is 20%. So your 80,000 divided by your 400,000. Okay, so they give us some benchmarks, okay? So here we're comparing modern industries, the amounts that we've already calculated, compared to benchmarks for that organization. So for liquidity, we're saying that modern is 2 times that of the benchmark. So your current ratio is 2 times, whereas your benchmark is only 1.5. So modern is better than the benchmark. Even the quick ratio for modern is 1.25 times, and the benchmark is only 1. So remember, the current ratio is current assets divided by current liabilities, and then your quick ratio or your acid test is your current assets, subtract off the amount for inventory, and then divide that by your current liabilities. So for both of those, modern is better than the benchmarks for that industry. However, not the case for the debt coverage ratios. So debt to total assets is 67% for modern industries, whereas the benchmark is 55. So of your total assets, debt for modern industries makes up 67%, but for the benchmark, the debt makes up 55%. So therefore, equity would make up 45 for the benchmark, and that is a better ratio. You're not as indebted as much as you would be for modern industries. Times interest earned, so the number of times you've earned your interest or the amount of times you can cover your interest is 3.1 for modern, as you saw in the calculation, but for the benchmark, it's 5. So if your profit before tax and finance charges can cover finance charges 5 times, it's definitely better than only 3.1 times with modern. Again, we're not going to cover fixed charges coverage. Looking at our average collection period, we're showing for modern, we're collecting within 27.7 days. Our benchmark is showing 35, which isn't very good because, as you know, most times when we give terms to our customers anyway, it's for net 30 days, as in the bill is due within 30 days, and the benchmark doesn't quite meet that. Inventory turnover is showing that it's better. It's turned over 9.3 times for modern, only 8 times on average for the benchmark. Capital asset turnover for modern is only 3.1, whereas benchmark is 4.5, which is better, as well as total asset turnover, which is 3.5 for the benchmark versus only 2.1 times for modern. Then our profit margin on revenue, as I said, we're not going to cover that. The return on total assets is 6.7 times. Benchmark is only 5.5. And the return on equity is 20 times versus 15. And for some reason, in this, looking at the benchmarks, they didn't look at the return on revenue. But as you know, the return on revenue for modern was 3.2. Okay. So again, what do we need to do to make these ratios meaningful? Number one, look at trends. So for modern industries, the best thing to know for sure how they're doing is look at last year or even the year before. And how do the ratios compare? Are they getting better or are they getting worse? And then the second one is compare the financial performance with other businesses that would be competitors, so in the same industry, or the industry averages that are often available. And then by comparing those, you'd see, as we just did in the previous slide, how modern industries is doing. Okay. So again, the limitations of financial ratios, they only give signals. So they don't answer the questions related to why, what, and how. So when you find the ratio and you see that you're not doing well, that's when in an organization you need to start looking deeper. Or even as investors, comparing one ratio or another ratio and seeing how they all intermix and intertwine and what one tells you compared to the other. Also ensure that numbers used are similar. Business sizes may make a difference, and the nature of operations definitely makes a difference as well. So for example, whether it's a brand new facility or if it's an older, kind of worn out, old technology facility. Okay, so hopefully this has helped. And if you have any questions, please let me know. But I will also be doing another video to go over Eastman Technologies for you. Thanks, everyone.